how to stick to your plan when losses hit pretty hard. And in this video, I want to show you exactly what my process is when my positions go underwater, what it looks like when losses hit hard, and how to stick to your plan, which is actually much simpler than you think. My name is Eli, I'm a professional options trader, so let's get right into the video. So what it looks like when losses hit hard and how to stick to your plan or not to stick to your plan. Maybe you should exit early. This is also a possibility, which actually can happen way more often than you think. Sometimes you do need to break the rules and exit the position early. So, and I'll give you also a few examples from my recent trades after we go over the slide. So if your short options position is down 50% of credit or more, it has the potential to become a pretty big loss. So at a negative 50% loss of credit, I always take action with the position. Doing nothing is not ideal in 95% of cases. Now there's, those 5% of cases where doing nothing is actually the best thing, and it depends on your strategy and whatnot. But for me, usually doesn't end up working too well. My positions rarely get to a negative 50% of credit, and when they do, they usually end up as a much bigger loss. So step one, I want to read the news to understand what caused the price to move against me that hard to get my position to a point where it's almost negative 50%. Then step number two, I have to answer one question. Are these news critical or not critical? If yes, I will close the position or hedge heavily on the tested side. And if the answer is no, I won't do anything or just roll the position, which is also pretty rare for myself. So step 2.1, if the news are extremely critical, for example, April 2nd tariffs, I will close the position or heavily hedge my position. So if the price keeps moving against me, I will end up profiting. And when you hedge, and I will make a separate video about hedging. By hedging, it can be done by buying or selling the stock or the future itself, or buying many cheap options with a much shorter DTE, which will end up costing you money, but will probably protect you. Now, step 2.2, if the news are just hype, so meaning they're not critical, I would roll the position out in time or won't do anything if the strike is far from the price, which is the least ideal thing to do. And but it is an option. Sometimes the option that makes the most sense. So I'm will show you an example for critical and non-critical news, where I ended up not doing anything on one side, and then on the other side where I did end up taking action because the news were critical. So let's go over the graph. I think this is pretty self-explanatory, but this is the exact process I go through every single time. And it just, it simplifies everything, makes it much easier. Let's look at some examples. So this is an example of a position I had on soybean futures. I opened it when the price was right around here on Wednesday, August 13th. And what happened here, the price kind of went up, volatility went up because we had a report for more exports or more previous exports, more previous demand for soybeans. And volatility was good. Price has been moving sideways for quite a while, so I ended up choosing these strikes, 1110 and 950. And the position was doing pretty well. I think it was up 22% up until we get to a certain day where you can see the price just popped up almost 2%. And as you can expect, volatility expanded. In this situation, the position went up from plus 20% to down 20% really quickly within one day. Obviously, this is not typical. So even though I'm not nowhere close to the negative 50%, if there's a big price move, you should definitely be able to just kind of go ahead and see, okay, what caused it? Is it critical or not critical? So I don't even wait for the negative 50%. If there's a potential for the price to even get to a negative 50% of credit, I always want to be reading the news. And I read the news regardless if the position is doing well or not every single day or multiple times a day. I think it's just good practices. So what happened here, the price went up on the hype, the premise that traders were expecting to China to buy more US soybeans. And if you know soybeans, you know that, or if you know US soybeans, you know that China is a pretty major purchaser of US soybeans. So they create a lot of the demand for this product. So there was a lot of hype that China might buy again from the US because they haven't been buying for multiple months because due to the trade war between US and China, they have been avoiding buying soybeans from the US, which makes sense. They're not going to go ahead and just buy any products from the country that they are having some I guess difficulties with the tariffs and the trade war. So it was, for me at that point, it was just pure hype. I couldn't I couldn't find an actual report or any government agency that actually hinted that China will end up buying any soybeans. And if you dig even a bit deeper, and you can also look at all the news just over here, it pretty much covers everything you need to know, for myself at least. Yeah, it was also mentioned in the news that China already secured soybean orders from Argentina and from Brazil for September, October, and even November. So China has already made its purchases from from other countries, right? So there's absolutely no reason for them to buy from the US. So this was absolutely clear hype, which obviously can turn into something real. Usually, if it's something more concrete, which we'll look at in 1 second, you'll be able to tell. This is just pure hype, right? So at this point, I will just sit and watch what happens with the position. Usually, when it's hype, it's just gonna fade away within a few days. So my expectation, it was hype. If it turns out to be something more, I would end up probably closing the position at 50% if something more concrete happens. So price went up a little bit more, and then price just kind of shut down and kept bouncing around. And on this day, I have closed the position right here for my full profit target. Volatility went down. The news came out that China clearly is not going to be buying anything. So it was all news driven, and the price just stabilized. And you would have made even more in this position, but regardless, it was a pretty good position. So it doesn't look like anything on a graph, but once you're in a position and you go from positive to 20% to negative 20% in a day, this should basically flip lights in your head, and you should go ahead and see, okay, is it critical, not critical, what are the news? Pretty simple. I ended up doing nothing. The position got to maybe negative 25, maybe negative 30% at the very, very worst, but ended up being just fine. So pretty easy. I think you don't really have to be a genius here, just a really simple process. So let's go over another position that I have actually just closed. So let's see if we can find a position here. Let's move forward in time. So this is gold, and I opened up a short strangle on gold. So let me just show you the day I opened. So I opened a short strangle on gold right here on, was it November 3rd? And these are my short strikes at the time. So at that time, there was no news. US and China were just kind of working on a deal. Everything looked pretty solid. The US government has been going down for over 35 days at that point, or over 30 days at least. And there was nothing really, no hype, nothing going on. And so the position kind of went up. I was doing pretty well. It was up 30% up until this day over here. So it's, within a week it was up 30%, which was pretty good. And then this day came, and on this day the position went up from 30% to negative 40%, right? So this is quite a big difference from plus 30% to negative 40%. So this is a pretty big price swing. So what happened here? So what had happened, we just came off of the weekend, and on Sunday there were finally reports about the US government reopening, and that it was very likely to happen during this coming week over here, and that there will be a bunch of economical data released that will support a rate cut. And rate cuts are very bullish for gold. So you can see gold went up quite a bit after August 22nd, when Powell gave the Symphonium speech where he sees quite a few rate cuts by the end of the year. So based on that, the gold just kind of shot up and up and up. So here we also had a few reports, and the gold just kind of had, one of its record days. So when that happens, for me, it's obviously a red light. I ended up closing the position for a negative 40%, and just kind of not playing around with it, because with the government reopening, this is something real. This is something we can gauge. It will reopen. Delayed economic data can definitely support another rate cut in December, and this is November as we are in a position. So these are pretty critical news, and I don't know what's going to happen. It might continue shooting up, it might not. So I decided it's not worth the risk, because things are going to get really, really choppy. It's going to be up and down, because we don't really know what kind of economic data was collected, how it will come out. And again, these things they do take a lot of experience to be able to tell, because I've traded at the previous shutdown in 2019. So this one is different, obviously, and it happened for a bit of a different reason. But if you're not sure exactly how these things can affect your position, a shutdown, reopening, or if something like this happens when a price goes up so much in a single day, and volatility expanded so much on that day, which was crazy. You can always use ChatGPT or whatever AI chatbot, and it will detail you, pretty well how this situation can possibly affect your position going forward. So what ended up happening? So I exited the position right here for negative 40%. And what happened is the price, for a day just kind of bounced around. It went up even more here. The position was down. It was down as bad as 200%. Right? I already closed it, but I had it opened on a demo account as well, just to kind of follow it. So it went down to over 200% of credit, which is quite a bit, and then it went down because the rate cuts expectations kind of went down. Now it kind of goes up again. If you look at today, it kind of goes up again. So it's kind of a roller coaster, and this is not. I don't want to be a part of this situation where there's too much uncertainty, because I can hedge heavily, and I can lose a lot of money on this hedge, right? So I will hedge heavily if I know for a fact price might actually go up, or I'll just close one side of the position and then just gonna open a position that can profit really nicely if price goes up. So hopefully this was pretty useful, because when things go bad, usually people just do nothing. Sometimes it's good, like I showed you in my previous example, but you have to be able to tell if the news are critical or not critical, and from there you can easily decide what you should do. You should hedge, should roll, or you should do nothing, or you should really just close the position, which is in many times the best thing to do, right? Even though it's not fun to take a loss, it is what it is. You have to be able to preserve your capital long term. This is the number one thing. Thank you again. If you have any questions, let me know. I'll be happy to answer them, and I will catch you in the next one.